Hello all, and welcome to the final Market Matters webinar for 2024. My name's James Gerrish. I'm the lead portfolio manager at Market Matters, and today I'm going to be joined by Shawn Hickman, our research lead, to run you through some of the key themes for 2025 as we see them. Today's webinar is titled Three Key Themes for 2025 and the Must-Own Stocks to Play Them. I actually hate that title. It's obviously been put through by our marketing team. I think it really should be around our ideas for consideration to build a well-structured and thought-out portfolio to take advantage of areas of the market that have got tailwinds for the year ahead, but that doesn't screen as well from a marketing point of view. So bear with us as we wait for others to jump online. They're streaming online today. And thanks very much for joining us. Our members who have continued to support Market Matters throughout 2024, thank you very much for that. And potentially new members who are considering Market Matters, we'll hopefully give you a few reasons to jump on board, and there'll be some offers at the end of this webinar today after we provide some clear insights, ideas around our three key themes for the year ahead. I'll bring in Shawn to say hi. How are you, Shawn?
I'm good, James. Less than 10 days before Christmas. It's an exciting time, fun time with the families and also in the markets as always.
Exactly. Last day of school today for my youngest. My oldest has been on holidays for about a week and a half now. Feels like an eternity. So let's get underway. So the structure of today's, that's not where we want to be, nor is that. Okay. So just to give you a quick understanding of Shawn and I, so we head up the investment function at Market Matters, both very, very experienced in the markets. I've got 20 years under the belt now of managing portfolios in the markets. Shawn's got over 30 years, was a prop trader in some of the larger investment banks before joining Market Matters over 10 years ago now. So two well-experienced guys, hopefully imparting some of our wisdom to our members on a daily basis. Before I begin, just a quick disclaimer that any advice provided today is of a general nature only, so it doesn't take into consideration any one person's personal circumstances. So it's general information only. As I do in all our webinars, we just give a quick overview of our investment process. We're top-down meets bottom-up investors. So we think about the macroeconomic environment, then we dig into stock selection, and ultimately we're about managing a portfolio. Rather than just putting out stock picks, we're all about managing a portfolio. And we think that's how you build wealth, get solid returns over time. And it's important to have those returns anchored to the risk that you're taking to achieve them. So that's what we're all about at Market Matters, not putting out stock picks, but all about managing portfolios within a structured way. Today's webinar is going to cover three key themes, and these are huge themes. So interest rates, we write about these and we talk about these a lot, but they are very important. The path to normalisation, so interest rates are coming down. It's a matter of when. Here in Australia, obviously, they've started coming down over in other parts of the world, with the US set to cut interest rates again tonight. So we'll run through why that's important and then look at some sectors and stocks to benefit from that idea. But that is an overarching macro view that does filter into a lot of our positioning across a broad range of our stock picks. Artificial intelligence, obviously a huge area of the market in 2024. The rise of NVIDIA and others over the course of the year. We'll look at, can that growth continue? And I think it's pretty obvious that level of growth will continue and will expand into other areas. So that's an interesting component we're going to discuss as well. And then energy and decarbonisation. So we're going through a huge energy transition at the moment. It's going to take a long time, and we'll cover some of the areas that we like in that space. So why are we covering these three areas? I thought I'd just give you a quick overview of the reasons why. So interest rates, they're a key component in all asset prices. So US 10-year bond yields is commonly understood to be the global benchmark of interest rates. Higher interest rates means lower asset prices. Lower interest rates generally mean higher asset prices, all things being equal. And that's why they're important. Artificial intelligence. We think it's the next industrial revolution and it'll change everything. And we're going to give you some stock picks we think are sensible ways of playing that thematic. And then energy and decarbonisation. So between now and 2050, these are broad estimates, but the number's going to be big. It's going to be something like $6 trillion spent annually on decarbonisation projects as we work towards reducing our carbon footprint globally. So that is a key area and a key area that we focus on in our reports and portfolios. Shawn, give us a picture of interest rates here. There's a couple of Bloomberg charts on the screen just to give you our viewers an understanding of where the market is pricing rates.
There we go. I'll turn my speaker on. That would help. We saw a huge pivot last week by the RBA. Michelle Bullock has been very conservative over the last year and a half since she's been leading the RBA, and the market hasn't believed her, and they've been wrong. She's been saying all along, inflation is sticky. In fact, for quite a period of time when the market was pricing in rate cuts, she was even suggesting rate rises were not off the table. Last week, there was no doubt her rhetoric was far more dovish, and the market is now looking for 3 rate cuts in Australia, which we're seeing over here, over the next 12 months, maybe less than 12 months. We think that's about right. We think that there will be 1 rate cut at least this financial year. The market's looking for 2. The market's 50-50 whether we get 1 in February. I think those are all like, toss a coin noise. The bottom line is Australian interest rates will come down next year, 2, maybe 3 times. I don't think it'll be any more than 3. And that, by definition, will put a tailwind back into some parts of the market more than others. And overall, it improves valuations of equities.
It does. And where we sit here today, so if I'm thinking about equities, where they are and what's priced into the market at the moment, it is lower interest rates, as Shawn alluded to, but it's also a soft landing from an economic standpoint. So, you know, we're pricing earnings to hold up, economies to continue to grow, but interest rates come down. So we are sitting here with a sort of a Goldilocks scenario being priced into the market. So as we start 2025, we're going into a Trump presidency. Obviously, tariffs are going to be probably the word that gets sprouted most. There's going to be increasing volatility. So I think in the context of what we're speaking about today, we are conscious that equities are at elevated valuations. We are conscious that the market is already pricing in a soft landing, and we are conscious that there are going to be some variables that could well hit the market or create some volatility at the start of 2025. So we're certainly alert to that, Shawn, and we write about that on a daily basis. And that's, I guess, one of the advantages members get through Market Matters.
Exactly. I mean, at times it's hard not to be boring when repeating ourselves when some of these factors are so important. Sure, the market's elevation, stocks are rich. Today, we're switching from CBA into ANZ or partly in the income portfolio, which we'll go into later. A lot of that is around interest rates, around valuations. It's a very, very important factor because what happens, the market goes through rhythms. It's something we've talked about over the last week. And the market at the moment is very happy with higher valuations. That will change at some stage next year. And when that does, some of these other stocks will come back quite hard. And that's what the market does. The market moves and in ebbs and flows. At the moment, it's very happy in all areas. That will change, come and go.
Yeah, I think it's happy to push the stocks that have been performing up further, and irrespective of how overvalued they are relative to peers. So Shawn was alluding to just a slight tweak in the income portfolio today, simply trimming CBA and buying some ANZ. CBA now trades on nearly 27 times earnings versus ANZ at 12.7 times earnings. I understand, and we obviously own CBA, that it has outperformed the banking sector for a reason, but these are extreme multiples. The same is true in the consumer discretionary space, with JB Hi-Fi trading on 23 times, about 10 PE points above something like a super retail group. So I think investors we talk about markets being rich, but it's not all rich. That's not all the case. I think we go into 2025 believing that there's going to be some key themes we need to be across, and we're going to run through those key themes today, but also with the view that there's money to be made in terms of stock picking. So as dynamics change, as market gets more volatile, stock picking comes to the fore. And I think that's what we can, I guess, well, we hope to add value through into 2025, Shawn.
Exactly. At the moment, as James said, we've basically got a situation where we had a year ago growth at any price. You often saw that phrase, GAAP. At the moment, we're almost seeing quality at any price. So the best retailer, JB Hi-Fi, the best bank, CBA, people are just buying them without any thought to the valuation. And it's worked all year. Give or take a few little tweaks, it's worked. But by definition, that doesn't mean that will be the next chapter and the chapter after that.
Absolutely. Absolutely. Okay, so let's crack on. So one of the key themes, so obviously we speak about interest rates being really key from across all asset pricing. So from pricing of the markets, pricing of equities relative to bonds, and so on and so forth. But there are a couple of key specific sectors that benefit from lower rates. One of those is infrastructure, and there's a couple of stock ideas here in the infrastructure space. Today we're going to be short and sharp. We're going to focus on stock ideas, stocks that we like, that suit a particular theme. So we think rates are coming down. We think infrastructure stocks, those that have consistent, reliable earnings, and pay those earnings out as high dividends, which that grow over time, will be more highly prized. And DBI is a stock that we own in our income portfolio. We haven't owned it that long, so it's obviously had a good run, but we haven't owned it that long. It's a high-yielding equity with take-or-pay contracts in the coal space, so we know what they're going to earn into the future, and we know what their dividend is going to be. I like that stock, Shawn. And I might just so we're still happy to buy DBI at these current levels, 345. APA Group is another one, Shawn, that has been. We're going to try and put things that have run well and those that are deep value at the moment. I think APA Group falls into the deep value camp.
Oh, absolutely. And we recently bought it for the active growth portfolio, which in some regards people would say, well, is it a growth stock? But you and I disagree at times that to me a growth stock's one that goes up, but that's what makes a market. But, you know, if we look at some of these stocks, they are going to pay a very, very good yield. And assuming they do appreciate in time, which we believe APA will. Obviously, that chart is an example about trends having been very persistent over the last couple of years. But, you know, APA is set to yield over 8% in the next couple of years. So that gives you a bit of a buffer into the business model as they improve things going forward.
So the simple way of pricing APA, and over time this thing trades on about a 2.8% spread to 10-year government bond yield. So call it the US 10-year at 4.4%. Over time, it's traded at 2.5% premium, if you like. So the margin you're getting compensated to hold APA Group over and above US 10-year yield, 10-year treasuries is 2.8%. So right now we're sitting at a higher margin to that, and we think that well and truly compensates the risk of taking on that you take on to own APA Group. It's had obviously some issues from. It's a regulated utility, so it's deeply involved in government, and because regulations can change, they've had some issues that they've worked through for some of their pipelines. And without going into the details, the majority of those have been resolved, and that's why we've had it in the income portfolio for a while. We did actually have a really strong we made 40-50% out of APA Group in 2023, selling it near enough $12 from memory, and we went and bought it again sub $8. So it has been good to us, even though we're down on the position at the moment. We have had the conviction to go and add it to the growth portfolio on the expectation that this is, as interest rates come down, this earnings stream, which is going to grow, will be more highly prized.
Exactly. And just to clarify, James, last night, the US 10-year bonds, they closed around 4.38%. So if you're getting a yield above 8%, that's a big gap.
It is. Well, it's the biggest premium that APA Group is trading at relative to 10-year bonds in its history. Another important point is that APA every year has grown its distribution since listing. So it has never cut the dividend, even through all the difficulties we've had since they listed. Property is the obvious one. So Obviously, there's a lot of focus in property markets and residential property, etc. But listed real estate investment trusts on the ASX, they've had in the last month, or December so far, is the weakest performing sector out there. We think this pullback is presenting an opportunity, and national storage is one of the stocks that we like and we hold across 2 portfolios, Shawn.
I'm very, very keen on national storage, as you know, James. I think it's actually a macro thematic as we move towards higher density living, as the government starts to get the ball rolling, albeit slower than we would hope, in building higher density living. People still like to have too much stuff. They've got to store it somewhere. And we're seeing more and more that national storage will have a higher demand. That will be supportive of their prices. And you can roll on the numbers from there. So I think national storage is very well positioned going forward on all levels, and it's set to yield close to 4.5%, 5% coming forward, which is good return.
It's a lower yielding REIT, so I think a lot of people shy away from buying NSR because it doesn't screen that well from a yield perspective, but they do have underlying growth that is going to underpin growth in yield. So growth in yield is really important when you're thinking about interest rates moving lower, and if the yield can be moving higher at the same time, that creates a bigger differential, and the stock becomes more relatively attractive from that perspective. So down around 240, we really like this one. I think this is the other thing is, over years, it has had a couple of takeover attempts put forward for it. I think this really lends itself to an international player coming in and buy it. They've got a great footprint. They're the largest self-storage provider in Australasia, and they are a high quality operator. So there's another one in the space called Abacus Storage King, which we've looked at multiple times and know that company pretty well. It was spun out of Abacus. But we think staying with the quality in this end of the in this space is really important. And national storage is that higher quality operator in the self-storage space. So 240, we think it's a buy. MVAC, this has come back below $2. This is another property stock that we own. We've bought it around current levels. We like it here. We think it's not going to shoot the lights out, Shawn, but we think below $2 has got good risk reward.
Exactly. We wrote about MVAC this morning. We also touched on national storage. They're both slightly different companies, or very different companies. NSR has that takeover possibility, and it's not hard to see why, because it wouldn't be a complicated company to bring into a fold of a larger overseas business, as you say. With MVAC, again, as the property market, we need to build more places. We need to build more apartments. MVAC is very well placed for that. It's just a matter of time before we get that.
It's a more diversified. It's a more diversified player in the space. So and it's a lot more exposed to residential development. So obviously, resi has been a bit of a tough area because construction costs have been high and so on and so forth. Interest rates have been elevated. We think those things will change ultimately. And if we still see a situation in Australia where the economy holds up, and we think it will. You look at the employment data that got released last week, that was incredibly strong. So if we do get a situation where interest rates come down, yet the employment situation remains robust, then companies like MVAC will continue to, improve. It's been a bit of a slog. There's no doubt about it. They haven't really recovered after the COVID hit. They've had a few false dawns. I think they guided pretty conservatively at their last update as well. So I think there's room for upside surprise relative to where analysts are thinking earnings will be in 2025.
Exactly. And I think that's the key. We commented on that this morning. I think that over the next couple of years, the profitability, the margins will improve across their jobs. And hey, at the end of the day, they're in the space where we need growth, and that growth will come, in my opinion.
What we don't do at Market Matters is try and tell you to buy the stocks that have been an easy story, that have continued to, that are on highs. We're trying to give real life ideas that are stocks that are at attractive levels that we would be happy to buy here. So we own MVAC, and we would be happy to buy it here. It's in our active growth portfolio. The other one that we've got a bit of a smaller company, a bit more leverage to interest rate cycle is Centuria Capital, C&I, property funds management business. They are highly leveraged to interest rates. They hedge less of their debt than some of the larger players in the space. So they're a bit edgier in terms of their exposure to interest rates. C&I is an interesting one there. So just jump off there, James Carter. In terms of C&I, sub 190, we certainly like it. And it's in our emerging companies portfolio as well as our income portfolio. Let's get on to things that are really interesting and really hot at the moment, Shawn. AI. Obviously, AI gets written about a lot, but it's such a huge topic, and I've got no hesitation in saying that it's sort of the next industrial revolution. It's going to change the way a lot of companies operate. NVIDIA has been the pin-up for 2024 in the AI space. I'm not showing it here because we think it's a buy at the moment. I'm showing it here for the growth that it's achieved over the past 12 months. Stock price is up 165%. Everyone is super bullish on NVIDIA. We've had some trades on NVIDIA. We don't own it in our international equities portfolio, but it is indicative of what's playing out in the AI space. And we think there's a lot more to play out, and we've got some ideas on how to play that very shortly.
Exactly. I mean, NVIDIA is the classic picks and shovels about the AI transition, which is only just beginning. Microsoft commented that AI is going to be the biggest industrial revolution in the next 50 years. But remember, it wasn't that long ago, less than 50 years ago, when the internet didn't exist. So this shows you how big people think the AI revolution is going to be. It's going to be absolutely enormous.
If you spend a bit of time understanding the depth and breadth of what's playing out here, you can understand why NVIDIA has captured the market's attention so much. You made mention of Microsoft, and I'm going to go there now because I think this is probably the broadest, lowest risk way of playing this move into AI. We've got this stock in our international equities portfolio. It's a core holding in our international equities portfolio because they've got so many different areas that are exposed. Obviously, to the broader tech space, broader move towards cloud-based solutions. So cloud is really important because it underpins AI and the ability for a broader use case for AI. So Microsoft has been at the forefront of technology for the last 50 years. They've built a hugely diverse business. And if I'm looking for a low-risk way of playing AI, Microsoft to me is a must-own stock. I know I said I hated that must-own terminology at the start of this webinar, but if I was putting one stock on it, because it operates in such diverse areas of technology, it's ingrained at the enterprise level, it's ingrained at the individual level, and it's going to be obviously a huge backer of OpenAI, which owns ChatGPT. They're not going to miss this AI revolution like they missed the mobile revolution back when that was taking place. So Microsoft, it actually only trades on, when we're talking about valuations before, CBA trades on 26, 27 times. Microsoft trades on 32 times. Microsoft is growing earnings out for the foreseeable in our forecasted future by 15% per year compound. That to me is really exciting. The biggest growth part of their business is AI, or it's going to be in Q1 in the first quarter of 2025. So to me, that is a standout. Even though it's had a good run, it's only up 22% this year, which relative to NVIDIA, which has put on 160%, and some of our other edgier exposures, international portfolio, Microsoft to me is a core holding and will remain that way, Shawn.
Yeah, I think you obviously like it, James. But I think it's a phenomenal stock, phenomenal business, and some people have noticed. Okay, I put a trading idea in the report on a Monday quite often, and I could happily go along Microsoft from a trade. Exactly where one puts the stop, probably a bit trickier, but I think it's got 500 all over it before you'd even reassess. It looks fantastic.
when we talk about when I'm talking about ways to play AI, and we write about this a lot. We say the risk reward looks good at this point, or the risk reward looks good in appealing in this stock. And when you're marrying up risk and reward, you've got to think about the exposures of the underlying business. So whether or not it's a one-trick pony or it's got diversification, whether it just deals with a very small cohort of customers or it's got a broad range of customers, how sticky and ingrained are those customers? And when I look through Microsoft, it screens so well from all of those those aspects.
And it's just got a phenomenal track record of successful execution, which also can't be ignored.
All right, so we like Microsoft. I mean, it's a bit of a boring one on AI, but you've got to think about areas that deliver a good risk reward. Bring it back to home. So the data center space locally has been a little bit more, well, it's obviously had a really strong year is the first thing. We're now seeing a lot more capital flow into this area. We've seen NextDC, first mover advantage in the space. We've now seen Goodman, which we have actually just recently sold out of in our active growth portfolio, which is a little bit, you might sit here and that's counter to our views here around liking property and liking the advent of AI and the push into AI. But it also comes down to what's built into the stock price. And a lot of these companies have got a lot built into the stock price. I'd argue in the last week or so, or probably longer than that, that NextDC has had a bit more, I guess the risk reward looks more compelling, Shawn, here in terms of NXT, around that 1560 level.
I think it looks fantastic. Anywhere under $16, I really, really like it. One of the reasons it's been sold off, it's been obviously the listing of Digico, a bit of money came out of some of the stocks to fund that big IPO. And I think that's creating an opportunity. And with Goodman Group, don't forget, it is still in our hit list for the active growth portfolio. We're not saying we don't want to own it. We're just saying we want to own it closer to $30 than where it is today. But right here, right now, we feel that NextDC is great risk reward, great value at these prices.
Yeah, so we're backing. We've shifted from Goodman. NextDC raised some capital, which gave us an opportunity to buy that stock. We've added to it since, and we think that's probably a better play, more established play in the data center space right now. So Goodman is still building out their data center capability as we speak. So each year, Goodman starts the year by saying we're going to do EPS growth of about 9%. The market understands that each year they upgrade, so the market gets ahead of that and starts to factor in 12, 13, 14% earnings growth. I think this year is going to be more of a challenge for Goodman to deliver that level of earnings growth, given what they're reallocating a lot of talent, assets, etc., from the industrial space into the data center space, which is complicated. There's no doubt about that. They're making big moves, allocating large amounts of capital into the data center space, and I think there may just be some timing anomalies around when that's going to have a positive impact on Goodman earnings relative to the share price that is trading near enough to record highs, whereas NextDC has pulled back on a cap raising on the listing of Digico, which at $5 listing is a huge IPO, $2 billion IPO coming out of HMC, $5 listing, and it hit a $4 low the other day. So it's obviously back up there, back up near the $5 listing today. But it's a volatile space, so we think NextDC as an established player looks good here from a risk reward perspective to play the AI thematic, Shawn.
Oh, absolutely. And just coming back to Goodman Group, if it wasn't for the fact of how successful Goodman Group and Greg Goodman have performed their execution, a bit like Microsoft over the recent years, I believe that the way that they've pushing forward into AI and into data centers more specifically would probably have seen a sell-off in a weaker stock.
Yeah, I think, well, it's a good lesson, right? So as investors, we need to evolve. We're effectively allocating capital. So we need to evolve when things evolve. And I think Greg Goodman has shown that he's willing to evolve Goodman in towards themes that stack up. Don't forget the Goodman nearly went out the back door in the GFC. So after that experience, they had too much debt. They've now evolved into having very little debt on their balance sheet. So you learn as you evolve as you progress as a business owner, a business manager, as an investor. And I think this shift into data centers is really exciting for them, but I think there's, from a timing point of view, we'll probably get back at that. We'll probably get back into that stock at lower levels, whereas we think next DC is a cleaner way of playing that thematic for now.
One other thing, sorry to interrupt there, James. We might even end up buying back into Goodman Group in the next year or two at higher levels. We haven't got ego at Market Matters. We made a decision to take profit recently on Goodman Group, but it doesn't mean we'll only buy it if we can buy it cheaper. If we see the earnings coming through, we see the company delivering, then we the risk reward profile will change, and we might end up buying at a higher price. It's not off the table.
All right, you got to be fluid in markets. Okay, so this is boring, but BHP. So the next thing is around the energy transition, moving towards net zero by 2050. There's going to be a huge amount of money spent on decarbonising the globe over that time period. We've just put BHP up here because they are now very much focused in future-facing commodities. Copper is going to be key in terms of underpinning the energy transition. Iron ore is also going to be very critical in underpinning the energy transition. You can't build a wind turbine without iron ore. So I think it's a really interesting area given where BHP is trading near $40. It's hurt us recently. BHP hasn't been good to us this year at all, but we still like it here, and we think around $40 is a reasonable entry point.
Oh, exactly. I mean, we were underweight for most of the year, and we've gone nearer to market weight now. But yeah, it's also at the moment, it's all about China. The BHP story is very, very linked to people's perception about China. But going forward, as James said, we do like the thematics coming out of BHP, and we really like how the company is positioning itself for the next decade, not the last decade.
It's a hard trade at the moment, the commodities. There's no doubt about that. But I think you've got to have the conviction to remain patient in some of these trades that are difficult at the moment. BHP is certainly one. I mean, it's back down at the bottom of its range. We often write that we're keen buyers of BHP at 40, and we're more keen sellers nearer 50. And I think that's still what I still think that plays out here, Shawn.
I totally agree. I'm very comfortable with BHP. If it goes significantly lower than here, if it was to drop another 5% because China misses the ball, drops the ball, it might even be tempted to go overweight BHP. It's still a world-class miner that will get that turnaround when the story goes.
All right, let's move on to something, another stock that has been under pressure. So one of the things that's happened right across this energy transition trade. So when it started with the lithium space, obviously with the huge run up in lithium prices, huge run up in lithium miners, and then the huge correction is that those higher prices incentivized a lot of new production to come on stream. The same would be true for the companies like Worley. So Worley are an engineering company. They were traditionally involved in a lot of maintenance work in oil and gas, etc. Typically very low margin business, dirty business, where things could often go wrong. But if you're a global engineering company that's now got to focus on decarbonisation, the energy transition, as Worley do, they've experienced a big change in their order book, and their order book has moved more towards decarbonisation projects. Those decarbonisation projects have come with higher margins, and ultimately, if you can expand your margins with a large revenue base, sort of like banks. Banks are a big revenue-based business. They operate on slim margins, and when you can expand those margins, then it can have a meaningful impact on earnings. So that's the thesis on Worley. In the short term, it hasn't played out as quickly as many thought, Shawn.
Oh, probably quite the opposite, James. It's come off a bit further than we anticipated, but again, I really like how it's positioned moving forward for the future. But like all cycles, the downside seems to be going a bit further than we anticipated. Hey, the lithium price and the lithium stocks have fallen an awful lot further than most people thought. And there is a correlation here, even though there's no correlation in terms of earnings, but the miners are spending. And if they're not growing as fast, then Worley suffers accordingly.
Yeah, absolutely. So, I mean, this is trading relatively cheaply to where it has historically, and the outlook for their business in the next 12, 24 months has improved. I think what the company did say that some of the, I guess, intensity of the way their customers were spending had eased a little bit, and the growth they saw in that space in 2024 had eased a little bit, and that's aligned with our thinking in the space. So obviously, the way we've positioned our portfolios is that the energy transition is going to take longer and cost more than anyone thought at the outset. And we certainly think that's the case. And this is impacting Worley in the short term. But if I look out further than the next 12 months, this business is ideally positioned, trading at an attractive valuation with long-term growth. And a business that is no longer, I guess people didn't appreciate Worley's the financial metrics of their business. They were pretty subpar, if I'm being honest, over the last few years. But this shift towards sustainability work has really changed the dynamic of that business, and I don't think the market is appreciating that changing dynamic with the share trading at $13.25.
Well, no, that's give an idea, put it into perspective. That's 17% below its average valuation of the last 5 years. So without getting too pedantic, it's on the cheap side in a market where a lot of pockets, not all, are on the rich side.
And you would argue so on valuations relative to history. So when we look at valuations relative to history, it's not the be all and end all, but it is a guide we use. So then you think about what's played out for a company historically and whether or not the future looks similar or better or worse, and that can guide your decision on whether the valuation discount is warranted or not. So Worley's actually, call it a 20% discount to historical valuation, but the outlook for their business has actually improved from a top line growth level, and then the quality of the work they're now getting will improve earnings over time. So to me, it's going to be a higher quality business in the next 5 years than it was in the last 5 years, and probably should warrant, and it probably should warrant a higher multiple than it has traded on in the last 5 years, in my view. All right, copper space, Sandfire. We're up a lot in terms of our Sandfire position, but it's pulled back in the last week. It's down, I think, 9% in the last week. We covered in the AM report this morning. We've got a reasonable position in Sandfire. Well, it's 4% in the active growth portfolio now, Shawn. We like copper. Should we be concerned about Sandfire pulling back from 11?
No, but I think I did put a chart in one of the reports this week which showed that Sandfire had got ahead of the copper price. It got downgraded. I think it was Morgan Stanley downgraded to effectively sell, targeting $9. We have taken some profit off the table recently, as you said, James. We've only got 4%. I wish it was 3%. I'm very bullish on copper going forward, but I don't think it's cheap enough, inverted commas, to go back towards 5 or 6%. If it goes under $9, then we might well be increasing that position again.
Yeah, so I mean, it's only we're $9.50 at the moment. So you can see on the chart there, $9 is support for Sandfire. I mean, you've got to have longer term convictions and then try and time the entry exit or adding and trimming to positions. So we like adding and trimming to positions in our portfolios. That's one of the things around active management is having generally a portfolio of stocks that you really want to be involved in, and then trying to add value around the edges by actively increasing and decreasing the weighting towards those stocks that fit the themes that you're investing towards. So Sandfire for mine is an add below $9. You may mention the broker downgrade $9 share price target. That's the most bearish in the market. Many in the market think Sandfire's $11, $12 stock. I went to an investor day with Sandfire recently talking, and it was a technical investor day where a lot of their geologists, etc., talking about the huge scope of their assets, which to me has been one of the missing pieces in Sandfire over multiple years. So they've been a company that's traditionally underwhelmed in terms of their ability, their technical abilities, and I think that's turned around. So to me, Sandfire is executing. They've done so in the last half a dozen to 10 quarterly updates. They continue to outperform, and I think they justify a higher multiple relative to other copper companies. The other one we like is Freeport over in the US, which we own. Let's move on to a tough trade recently, Cameco, uranium space. So it's been a good trade for us in the international equities portfolio because we own Cameco. Obviously, uranium. Paladin's been more of a challenge here locally. What's our take on both of them, Shawn?
I am very, very bullish the uranium and nuclear space going forward. There's over 30 countries in the world, and most of the AI giants, tech giants, transitioning towards nuclear, positioning themselves for nuclear power to fuel the AI surge and demand in energy. Australia is one of the few countries that doesn't seem to be too keen. It's a real political football. But pushing beyond that, Cameco has delivered. Paladin hasn't. Paladin recently missed, but Paladin's in that situation, as we wrote about this week, where it's in the naughty corner. It gets a 3% downgrade, for example, on the uranium price. I think UBS downgraded. Boss Energy was the one we talked about it in the week. Yeah, UBS downgraded Boss Energy by 3%, and the stock falls by 9%. In other words, people at the moment have built big short positions in the local uranium stocks, and they're in the naughty corner, and they are going to have to come out with some decent production operational updates before the market turns that around. But I do believe strongly that they're in the right space. It's just going to take longer than we thought for them to get there.
So this is the thing with obviously Cameco is largest listed player globally in the uranium space. So it's got operations in all different jurisdictions, multiple mines, etc. And one of the things that probably I underestimated in terms of Paladin, this is a stock that we've made money out of, been in and out of, but we're in it at the moment, is the narrow nature of their production. So they're trying to, they're developing or bringing back online the Langer Heinrich mine over in Namibia. And to do that, they're working through stockpile. So stockpiles that had been put in place several years ago. Some of the stockpiles had lower quality product put through them when they'd been marked higher quality. So they've lost some pounds in the market, but the market has re-rated that stock by about $800 million in terms of their market cap, when the actual impact, financial impact, is about $60 million. So to me, I think the market understands that uranium is a real opportunity. I think we understand that. So the future of uranium looks really bright. The issue with some of these smaller Australian domiciled uranium producers is that they're more singular focused on one mine. They've got more operational risk as a consequence of that, relative to why not just stay with the big guys if we're backing a theme, or you can back an ETF that is also tracking the major companies globally. That's probably another way. Well, that is another way to invest towards that theme. So to me, I think that the market has gotten really bearish on Paladin, too bearish on Paladin at 770. I think it's a screaming buy, with the understanding that it's a super high risk. Right now, it's a one mine company operating in the uranium space, so it is super high risk. But as they work potentially by fishing over in Canada, and work towards building out their Langer Heinrich mine, I think it's got huge prospects for the future.
Totally. And the risk reward, to use that phrase again, below $8 looks fantastic. It was trading at 13 not long ago. And the reasons why it's dropped, or almost halved, as James said, 800 million write-off, it's taken off the market cap. It's just, I don't want to use the word ludicrous, but it didn't make sense to us. It just shows how much people have just thrown it in the naughty corner and said, we'll just buy Cameco, we'll just go with the big one.
All right, and then so this is an interesting one. So HMC Capital. So I've put this in here because this is actually a play on all the themes that we've just spoken about. So they're an alternative asset manager. They have real estate investments, so they benefit from, they're a fund manager, so they benefit from falling interest rates. They're involved in energy transition, and they're involved in digital infrastructure. So they had Digico, they spun Digico out. They're a major shareholder in Digico still, and a bunch of others run by David DePilla, who's really well respected in the market, ex-UBS. There's a lot of things to like here. Obviously, the share price had a huge run up. There's no doubt about that. And then it's come back pretty hard as the Digico IPO failed to live up to expectations. I think the other important thing here is it sort of looks like, it reminds me a little bit of, this is going to be a bad reflection, but it reminds me a little bit of the model around Babcock and Brown. So you spin out, you spin out funds, you retain a stake in those funds, you charge those funds management fees, etc. But these are good operators. So it's not, we don't own this stock at this point in time. We've looked at it. It was too rich for us as it's run up. It ran all the way up to $13, but I think it actually looks interesting here at $10 as a way of playing the themes that we've just discussed in today's presentation. So it sort of packages it up into a nice little bow for you.
No, absolutely. It ticks the boxes very well.
Yeah, I mean, it's yeah. So there's fund managers are alternative asset space is a really interesting growing space. So and these guys operate in different components of the alternative asset space. They're attracting a lot of FUM. And whilst the valuation is still a little bit stretched, I think this is it's an interesting way of getting exposure to these themes in the market at